Liberation Day 2.0 is now being talked about, and this is kind of crazy because initially I'm like, all right, here we go. This is just going to be fun again. Fear, uncertainty, and doubt causing news, and markets are just going to look through it, which they probably will. But what's actually interesting is we're probably going to experience a delay in data. Now, why would I say that? Well, because this morning, not only was CNBC really slow, which was hilarious. This morning in the course member live stream, we covered the S&P manufacturing data at 6:45. We're like, all right, let's see, this could have an impact here. The data came in great, okay? It was a beat across the board, which seems like great news. It took 4.5 minutes for CNBC to cover it, and there are people in the course member lives that are buying calls because we covered the data instantly. Institutions didn't care because people with the institutional data access are like, whatever. But as soon as CNBC started talking about it, the Qs skyrocketed. And what I want you to see is what's actually in that data. So what's in that data is a report that suggests, hey, prices are definitely rising. And in my opinion, that's going to keep the Fed on pause. But we already knew that. That's old news, right? But what's more interesting is that they basically talk about, hey, look, compared to the whole of the data in April, things are as good as they were in March, or maybe even going back to the highest since January. So in other words, data on services, manufacturing, and the composite numbers are better. They're better than the whole that we were in April. This is some form of a rebound. And I got excited about that. I'm like, oh, that's great, a rebound, that's fantastic. But then I got a little concerned because take a look at one of the comments from the economists at this company, or, the S&P Global. However, both sentiment and output growth remained relatively subdued, and at least some of the upturn in May can be linked to companies and their customers seeking to front-run further possible tariff-related issues, most notably the potential for future tariff hikes after the 90-day pause lapses in July. In particular, concerns over tariff-related supply shortages and price rises led to the largest accumulation of input inventories recorded in 18 years. Okay, so in other words, in March, we're like, oh my gosh, you need to get ahead of being liberated, build up inventory. You see companies like Restoration Hardware build up about 3 months worth of inventory and go down to like no cash. Okay, well now companies are like, all right, we have a pause on Liberation Day. Let's get ahead of the assignment of tariffs. Remember, Donald Trump says he is going to assign tariffs to any country that does not make a deal with the United States. We already have a 10% base level of tariffs. Is that potentially going to rise? And how meaningful is that realistically going to be? Is it just a bunch of FUD? Fear, uncertainty, and doubt. Well, institutions seem to think that it's actually a reason to short markets. In fact, we're seeing a lot of people circulate this chart here. I want you to know that most of this shorting of the S&P 500 or the highest short interest in the NASDAQ 100, the technologies index in the last 4 years is primarily being driven by hedge funds, which makes sense. Hedge funds, this is what they do in these sort of times. They hedge. But when you actually look at a lot of the forecasts that we have for consumption so far looks like it might actually hold up, which is good and suggests that, hey, as long as consumers keep spending, then the buildup of inventory makes sense. Building up of inventory actually just enables lower prices for longer. And so that is a good thing, right? We basically, as long as we keep bringing in more data at lower prices, we keep doing well. Now, there are some charts that we want to pay attention to. The number one chart we want to pay attention to, in my opinion, has to do with actual growth. So far, Goldman Sachs suggests that our growth is still expected to be positive year over year. I know this is a little blurry. And that's mostly because growth in consumption is expected to fall, but still remain positive this year. For example, Goldman Sachs in 2024 said we saw consumer spending of about 3.1% of growth. That's expected to decline to just 1.2%, but that's still positive, right? That works out to about 39% of the growth that we saw in 2024. So it's definitely a slowdown. Now, does the slowdown matter? No, it only matters to the extent that this second chart stays low. And I make this comment regularly. I'm like, so far we haven't really seen a spike in layoffs. And then I get these comments, people are like, what are you talking about, Kevin? I just saw announcements that this company, like Microsoft is laying off and UPS is laying off and Walmart's laying off. Yeah, that's true. But You have to understand the economy is more than just some of the big recognizable names that you have. And so the easiest way to understand this is by looking at the actual layoff and quits rate. Quits rates actually increasing is a positive sign for the economy, although it's been trending down for a while. Right here, this is what you want to pay attention to though, the layoff rate. The layoff rate has been very low and stable since 2022, 23, 24, and through 2025. So until we see an actual spike in the layoff rate, like what you saw over here in the Great Recession, obviously COVID, but just ignore COVID for a moment, just look at the Great Recession, or even the elevated levels of layoffs that you saw in the dot-com bubble, you can see we're substantially below the levels of the dot-com bubble and certainly substantially below the highs of what we saw in the Great Recession. So as long as, yes, consumption might be slow, as long as we don't get the layoff rate increasing, I don't know, data might not actually turn negative. Now, I personally maintain that we'll know by October, maybe even September, because we're going to have the June, July, August data. Okay, old news. But what does Liberation Day do? Well, Liberation Day 2.0, based on this S&P data, potentially pushes that back to not overall back, like still looking, October, September being sort of your D-Day. But what it does is it sort of backloads the data. It says that data from May that's getting reported in June might be influenced, even data in June that gets reported in July could be influenced by, again, a front running of Tariff 2.0. Now, what does that mean for you? Like practically, what does that mean for you in the short term? Well, in the short term, it means stocks can keep going up. Now, remember, a lot of institutions today are saying, look, the S&P 500, based on where we think their earnings are going to be at the end of the year, at trading at maybe a 20x multiple, is probably overvalued by about 23% today. So broadly, the index, for somebody who's trying to look for valuation deals, is not in a deal right now. It's in an overvalued state. Does it matter if you're just buy the dip long term? No, of course not. But if you're somebody who's setting trailing stops right now, is saying, all right, look, I've got a lot allocated to stocks, maybe I've got margin, maybe your trailing stops are set so that way when your trailing stops hit, you just pay off margin and then you just ride out the wave, right? It's not a bad strategy. I see a lot of people doing that. They ride margin on the upside, but they set trailing stops to protect themselves from a further downside. And this S&P data, in my opinion, gives me sort of a little bit of a, that's interesting. Like, when are we actually going to get clear data, right? But what all it does is tell you that the Fed's just going to wait even longer to cut rates, which sucks. Now, the JP Morgan reports that they're tactically bullish. They actually think that we've got resistance around the 6,000 level for the S&P 500. But overall, they think that stocks will breach all-time highs in the near term, especially as we get early June data, which actually aligns with some of this S&P global data that we're getting. So I don't disagree with JP Morgan that we could continue to see those all-time highs going forward for the next few weeks. Hence, again, stop loss is great. Unless, of course, you're investing in like Enphase, but everybody knows that investing in Enphase has just been a bad investment as rates being high and the actual fundamentals of people wanting to buy solar inverters, solar panels, batteries have been very difficult because when rates are high, the cost-benefit analysis of replacing your utility bill with really high interest rates isn't there. So it's been really difficult for the solar and energy companies. That said, good margins. Enphase will probably survive this cycle. 2028, the big beautiful bill cuts off the EV tax credits, the energy credits for solar, wind, and batteries. Sucks for home batteries. That 30% tax credit gets cut off in 2028. Maybe it leads to sort of a front running of sales, but not when rates are this high. So you're kind of in like this catch-22 where best case scenario for some of these companies is you kind of hope that rates get cut to zero in some form of a panic, but then you need a company that survives the crash and then comes back through a zero interest rate environment. I think Enphase is a company that could survive the crash, but I can't touch Enphase in this sort of environment. I haven't touched Enphase for a very long time. Even back when it was $100, I'm like, oh man, this sucker could go down to 35. And I think it's trading for like 38 right now, which is kind of crazy. It sucks because it is a great company. Yeah, it's trading for $38 right now. It's crazy. That said, what we want to pay attention to macro-wise is take our time. So far, none of the data looks like it's really going to give us anything bad. So business as usual. Keep the trailing stops. Keep chugging along. Now, we do need to talk about HIMSS. but only after we remind you that, hey, thank you to everybody who invested in House Hack yesterday. We had a surge of y'all investing in House Hack yesterday. Maybe it's something I said yesterday, but appreciate y'all. If you want to invest in the non-accredited round and diversify away to what we're doing with real estate and how we're using it as a downside protection vehicle, in our opinion, check out what we do over at househack.com or just watch my videos on House Hack. And again, you can go to househack.com and see some of the properties that we work on and invest. It's open to non-accredited investors.